Before you begin watching the Predicting Price series, I highly suggest you to first watch the model series and the trade breakdowns released. The reason why is because during this lecture series, I am speaking to someone who has already gone through those lectures, and therefore I anticipate the viewer to have a certain level of understanding algorithmic price delivery already. If you do not follow this guideline, do not be surprised if you do not understand the basics of everything that I will share. Enjoy this lecture series. Hello there, I hope that you are doing well. Welcome to the first lecture of the Predicting Price series. During this lecture series, you are going to learn how we can predict the delivery that's likely to come next. Meaning, we will discuss delivery profiles in great detail during this series. What you will learn during this series is how to anticipate the delivery of price within the next time cycle. Because time cycles are fractal, we will first begin with the larger time cycles. Based on the larger time cycles, we are going to move down all the way into the smaller time cycles. And that way you're going to learn how to incorporate your higher time frame analysis within your lower time frame trading strategies. This lecture will be on monthly profiles. Buckle up so that we can begin with today's lecture. Let's take a look at the table of contents for this lecture. First of all, we are going to discuss the importance of understanding higher time frame swings. Secondly, we will be paying attention to schematics. Thirdly, we're going to be paying attention to monthly examples. The importance of understanding higher time frame swings. Higher time frame swings set the stage for the lower time frame delivery. This right here is very important to understand because you need to understand that if you have a certain anticipation for how the month is likely going to deliver, the weekly profiles are going to represent that anticipated delivery. And because you have that anticipated delivery, whether it be, for example, bullish, you can look for lower time frame market maker buy models to take place, because that is what your higher time frame analysis is suggesting. And therefore, it's very important to understand the higher time frame swings, even if you're trading the short term. Without understanding the higher time frame institutional order flow, trading the lower time frame can feel very unstructured, because you are going to be looking at the charts and you will think to yourself that you see patterns in price, for example, a market maker buy model schematic or a market maker sell model schematic, but you don't really know which schematic is the real schematic, which model is the real model, and that is where understanding the underlying narrative comes in play. Let us take a look at time cycles and market fluctuations first of all. What I need you to understand is that when we have any particular time cycle, the purge and revert model looks like the following. When a new time cycle opens up, we always refer to the high and low of the previous time cycle. The high and low have been represented in the schematic through the green and red lines. The green line representing the previous cycle high and the red line representing the previous cycle low. What I want you to understand is that when we are anticipating higher prices for the upcoming month, what we will be looking for is the following. We will be looking for the month to open, drop lower, to take out the previous month's low, to then draw towards that previous month's high, because that right there is a bullish purge and revert. If we are anticipating lower prices for the month to come, what we will be looking for is the following. We will be looking for the month to open, reprice higher to trade into that previous month's high, take out that high, and then begin to draw towards that previous month's low. This is the bearish purge and revert model. Now that you understand the purge and revert model, we are going to be looking at the continuation model. The continuation model takes place when there is an urgency for the market to be repriced into a one-sided direction. What this looks like if bullish is the following, where we open up a new month and the month's open is right away or in close proximity to that monthly low already. The market immediately begins to run towards the upside. When we see the market then trade above that previous month's high, and we see the previous month's high get revisited right here, we anticipate that the previous month's high is going to function as support on price. Why? Well, we're anticipating higher prices for the upcoming month, and we're anticipating therefore that the previous month's high is not going to get taken out for a reversal to take place, but instead going to get traded above in order for it to be utilized as a support area, so to say, for the market to continue higher. If we're anticipating lower prices for the month to come, what we anticipate is that the month will open up and right away form the high of the month, to then begin to displace towards the downside. When we displace below the previous month's low, we want to see the previous month's low function as resistance on price because we're anticipating that we will be drawn towards the downside for the month to come. This is the continuation model explained. What I want you to understand is that during each new month, it's always one of these two scenarios that is taking place. It's either a purge and revert model or it's a continuation model. If the market is going to get stuck in between the previous month's range and it doesn't take out either the high or low, then it means the month is likely going to consolidate. But these are the two scenarios that I am interested in. The highest probability trade setups look like the following, where we see the month begin to open, drop lower to take out the previous month's low, whilst we're anticipating higher prices. This open to low right here is representing to us manipulation. If we're anticipating lower prices for the month to come, what we'll be looking for is for the month to open right here, for it to then be repriced towards the upside to take out the previous month's high. This right here is manipulation which is taking place. And when we see that previous month's high get taken out, we anticipate that we're going to form a smart money reversal right here to draw towards that previous month's low. This is again the purge and revert model explained, and this is, in my opinion, the highest probability trade setup, because you need to understand that this right here shows to you that true manipulation has taken place, and after true manipulation we can anticipate that distribution is going to take place. Here you can see a representation of what the ideal month looks like within a bullish order flow on the higher time frames. What I want you to see is that when we open up the new month, the first week we would like to see the market begin to consolidate. During the first week, we always have NFP, and NFP is a crucial news driver for the monthly delivery. What I want you to see is that when the market consolidates during that first week, we will be looking for the market to drop towards the downside during the second or third week. The second or third week is going to trade into a higher time frame key level where we're anticipating a smart money reversal to take place from. What I want you to understand is that this drop towards the downside right here is suggesting to us that manipulation is taking place. And what follows after manipulation? Distribution. We are anticipating higher prices for the month, and therefore what we will be monitoring is SMT to form right here on the lows with a highly inversely correlated market or correlated market. When we see that SMT form during the second or third week of the month, we can anticipate that during the third or fourth week of the month, we are going to see the market begin to expand towards the upside and draw towards buy side liquidity. First of all, resting above the high of that first week, and secondly, above, for example, the previous month's high or another higher time frame key high. Now, what I want you to understand in this schematic is the following. If we move on the slide, you can see that I've annotated this delivery right here with a gray box. If we're anticipating higher prices for the month to come, what we'll be looking for is for the market to drop below that monthly open. We want to position ourselves long below the monthly open because we're anticipating that we are going to open low and then eventually draw towards the upside. This is our anticipation for the month to come because we know that we are likely going to draw towards buy side liquidity next during this month. How we can determine that we're likely going to draw towards buy side liquidity next is by paying attention to, for example, the yearly cycle. When we understand that we are bullish for the month to come, we will be looking for the open low formations to take place into a key level at the right time paired with SMT. When we see those signatures, they confirm to us that we are likely going to reverse and begin to draw towards buy side liquidity next. The run lower is required before we can continue higher. In order for us to go higher, we must first draw lower. And that is a key takeaway which I want you to write down. The open low for this month is very important. If you want to see an example of this, wait a bit because we will look at the real chart examples soon. If we are anticipating lower prices for the month to come, what we'll be paying attention to is the following. We want to see the first week ideally consolidate. Near the end of this week or during the beginning of the second week, we want to see the market begin to run towards the upside. We want to see it be repriced towards a higher time frame key level. When the market reaches this higher time frame key level, we are anticipating that a smart money reversal will form there during the second or third week. When this smart money reversal is taking place, we want to see SMT on the highs right here taking place. This SMT confirms to us, due to the fact that intermarket relationship is suggesting that current correlation with an inversely correlated or correlated market, that SMT is suggesting to us that there's manipulation which is taking place. When you pair this with the underlying narrative that we're going higher to go lower and that we have reached a key level during a key time, we can anticipate that the next move which will take place is sell side delivery, where the market will be drawn towards sell side liquidity next. We ideally want to see the market begin to expand towards the downside during the third and fourth week for this month. Notice that this only takes place when the underlying narrative is that we're anticipating lower prices for the month to come, and therefore we must first see the market go higher before it can go lower. Now, with that being said, let us take a look at the manipulation which took place. The manipulation which took place is right here. All the delivery above the monthly open is where we want to ideally get short. Meaning, the moment that we reach that high time frame key level, we want to position ourselves short above that monthly open or in close proximity to it. The market opened up for this month and immediately repriced higher. But why is that important, you might be wondering? The fact that we opened up, went higher, whilst we're anticipating lower prices, is exactly what we're looking for. Because during this movement higher, you will see very positive news get shared. You will see a lot of news get shared around the globe, which will signal, yes, this market is bullish and we should all be buying it because we are going to go towards the moon, we're going to expand higher, etc. That is the narrative which is being shared to the public. However, what you need to understand is that when you understand that we need that opposing side of liquidity, we understand that such news has to get shared to trap people into believing a false idea. We know the real drawing liquidity. We know that the drawing liquidity is below market price. We know that we must anticipate the market to draw towards the downside. What can we logically anticipate the market to draw towards? Well, the first bread and butter objective is the previous month's low, which is resting at this level right here. When this previous month's low gets taken out, we move from there. Notice that this can also be another level. This can also be, for example, a higher time frame discount array, its respective high, or for example, a previous yearly low, etc. All that matters is that you know on the downside what the drawing liquidity is. Now let us take a look at some chart examples. Here we are on the daily chart of gold, and as you can see, gold has been repriced towards the upside explosively. Notice that this move towards the upside was very aggressive and there weren't many retracements. When gold was down here, I shared with you during the daily reviews that was anticipating gold to deliver exactly like this. My drawing liquidity was the 2700 price level. This drawing liquidity was based on the application of the advanced ranges as I taught them to you within the model series, the series which you should have watched prior to watching this series. Notice that we stopped during the month of September right in advance of that 2700 price level. To me, that was very suspicious. To me, that meant that we were likely engineering buy side liquidity above this September high, which we could draw towards during the month of October. What I was anticipating was the following. I was anticipating the month of October to open up, run lower into a higher time frame key level. The key level, or key range I should say, for me being this daily BC, and I was looking for the signatures that would confirm to me that we would form a low in this area to begin to draw towards the upside. We then saw gold this ways away from that daily BC, and we saw it create this BC right here. Notice that we retraced into that BC, into that bullish value gap, and then we expanded higher, drawing towards the September high and drawing towards that 2700 price level. What I want you to put emphasis on is the following. That even though you initially saw gold run up higher when October opened up, relative to the whole month, you can see that we dropped below that monthly open, form a low here, and then begin to expand towards the upside. That right there is crucial to understand because you need to understand that what matters is that we drop below the open into a higher time frame key level. Now, if we go into the hourly chart, you can see that I've done a lot of annotations on this delivery, but I'm going to walk you through it. What I want you to see is that during the first week of this month, gold was just consolidating. You can see that it was going back and forth, just engineering liquidity on both the buy side liquidity right here above these highs, as below the lows, the sell side liquidity. What I want you to understand then is that during the second week, we drop towards the downside and we take out all of the sell side liquidity resting below these lows right here. By taking out all of that sell side liquidity, the market dropped below the October open. The October open being represented by this horizontal line. We then saw the market drop into the daily basis price range, and we then saw the market begin to consolidate once more. What we then saw occur on Thursday was that gold created a lower low relative to the previous daily lows, relative to the Wednesday and Tuesday low. So we saw daily S&P here inside of that daily fair value gap with silver, because silver created higher lows. That right there shows to you that there's a correct correlation between gold and silver, which are highly correlated markets. We then saw the market begin to reprice away from the daily BC and begin to expand towards the upside. Notice that every single discount array which formed afterwards at key times begin to function as support and price. All in all, you see a very beautiful buy program where every single expansion higher was followed by a retracement, was followed by a new expansion higher, was followed by a retracement, and was followed by more expansions higher, followed by retracements, followed by expansions higher. When you understand that sequence right there, it's a very beautiful sight to see, because in that sequence, in that higher time frame delivery profile, lower time frame market maker buy models present themselves. Since this lecture is on monthly profiles, we're not going to zoom into the daily delivery and such, but I need you to understand that based upon the monthly profile, we were anticipating open, low, SMT confirms the low formation when it occurs at the right time, at the key level, and we then see a buy program take place. What is so important to understand is that you recognize what caused the change from sell program into buy program on the higher time frame chart. Eventually, gold dropped towards that previous month's high, which was right here, and it reached the objective of 2700. Now, if you pay attention to both gold on the left as silver on the right, you can see that the S&P is visible right here, where you can see that gold created a lower low relative to those previous daily lows, whilst silver created higher lows. That right there is S&P, because these markets should move in tandem with one another. When one creates a lower low, the other market should also create a lower low. But when this is not the case, it shows to you that true manipulation is going on, and we can anticipate that we're likely going to see buy-side delivery next soon. Here we're on the daily chart of the door. As you can see, the door has expanded beautifully towards the upside during the month of October. We anticipated this whole run higher, and it was a beautiful low resistance liquidity run. What confirmed to us that the time was right for the door to draw towards buy-side liquidity were the following signatures. But before we look at those signatures, I must first share with you that if the market is so bullish on the higher time frames, what do you think presents itself every single week? Lower time frame market maker buy model opportunities for the door that gets paired with lower time frame market maker sell models for example, the euro. What I want you to see is that I've annotated key time-based liquidity pools. I have annotated the August high right here, this August candle. I've annotated the August low right here. I've annotated the September high right here, and I've annotated the weekly low right here. I will walk you through the importance of these levels right now. First of all, what I want you to see is that during the month of August, the door did nothing but reprice towards the downside. The month of August was a very bearish month for the door. Then during the month of September, the final month of the third quarter, we saw the market just basically slowly grind towards the downside. We saw it begin to go back and forth, as you can see. When we took out the previous month's low, the August low, what we saw occur was that the market came into a consolidation profile, where a weekly low formed right here. Notice that we took out that weekly low and we then began to see the door begin to get repriced towards the upside quickly. We saw it begin to run higher. The reason why this run higher was so explosive was due to the fact that a lot of buy-side liquidity had been engineered during the past 2 months. During the month of August, of course, where we saw the door drop aggressively, and secondly during the month of September, where the door also grinded towards the downside. Due to the fact that these months were both bearish and the time was right for the market to draw towards the upside, lower time frame market maker models began to present themselves on the buy side, meaning we were anticipating every single expansion higher to get followed by retracements, followed by expansions, followed by retracements, etc. Now, what would confirm to us that the time was right for the door to begin to draw towards buy side liquidity next is a question that's on your mind. What I want you to see is that inside of this consolidation which took place, we need to be looking for a very specific algorithmic signature. The signature that we will need to look for is a Kraken correlation with the door and an inversely correlated market, meaning we will be paying attention to the door and euro, and we will see whether or not they behaved in the same way during this consolidation. On the left, you can see the door hourly chart, and on the right, you can see the euro hourly chart. The hourly chart of the door right here represents the delivery near the end of that consolidation. What I want you to see is that on the 27th of September, the door formed the low right here. Notice that when we opened up on Monday, the market created a higher low than the Friday low. If we, however, pay attention to euro, what we can see is that euro created a higher high on Monday relative to the Friday high. If dollar and euro would be moving in sync with each other, this would have never occurred, because when the dollar creates a higher low, euro should create a lower high. But because we saw euro create a higher high, whilst the dollar created a higher low, it was SMT to us, meaning we saw that the Kraken correlation which was present at a key time near the end of the month, and therefore we began looking for signatures that confirmed to us that the time was right for continuation models to play out. If we pay attention to this delivery again, then what I want you to see is that there was an SMT with euro on the lows right here. When this SMT took place near the end of September, what is October likely going to do? October is likely going to open up, immediately form the low, and begin to run towards the upside, because there's an urgency for the door to be repriced towards the upside. We see it trade above the previous month's high right here, above the September high, and notice that when we trade above the September high, the next candle opens up over sell side into that high and then displaces away from it. We see this big up close candle taking place. A daily BC, a bullish fire gap, gets created through this sequence of imbalances on the left side of the curve. Market retraces into that and immediately expands away from that. That right there shows to you that there's a real urgency for the market to be repriced towards the upside. But I want you to focus on this part right here. The fact that we utilized that previous month's high, that September high, as support right here, shows to you that the continuation model is in play. Where you saw a purge and revert model being in play for gold, where we took out a previous week's low and then begin to draw towards the upside, you can see that in this case, we did not take out the previous month's high and reverted towards the downside, but instead we took out the previous month's high, utilized it as support on price, and then begin to expand higher, trading into a premium of the overall dealing range which is present. What we can see is that institutional order flow entry draw is taking place right here, and the market expands away from this BC. It trades into this CB on the left side of the curve and spends some time right here. The moment that we close above that CB, we can see that it functions as support on price and the door begins to expand higher. It expands into a higher CB right here, and notice that when we reach the high of that CB, we reject it right here. The market retraces into this very small BC which formed, this bullish fire gap, and then expands away from this CB as well. The reason why I've outlined these two CBs right here is because I want you to see the beauty in algorithmic delivery, where you can see that these CBs functioned as support on price on the right side of the curve the moment that price traded above them. That right there shows to you that the underlying order flow is bullish. We see the market begin to accelerate towards the monthly high, towards the August high, and notice that we did not close above that high yet. We have repriced above it, but we did not see a full closure above it yet. Now, the reason why I have annotated all these key highs and key lows is because I wanted you to see that the fact that we kept on referring to those previous time-based liquidity pools during the month of October. Therefore, you need to understand that when you begin paying attention to these delivery profiles and you begin paying attention to how we're reacting to those key time-based liquidity pools, we can gauge the order flow. And that is what I want you to understand and take away from this lecture. Based on the reactions to these key levels, we can anticipate how we're likely going to deliver for the month to come. And the fact that we expanded higher during this first week of October above the previous month's high and it functioned as support on price, that right there screams that the schematic which I showcased to you of the purge and revert model for a monthly profile was not going to play out, and that we were instead going to see the continuation model playing out. For the continuation model, I will not provide you with a screenshot because the continuation model really depends on how we react off the previous month's high. All that matters is that we open up, run higher above the previous month's high, and instead of rejecting it, we utilize it as support and price, then begin to expand higher. I want you to see how, first of all, the monthly highs and lows were important, and when the monthly highs and lows do not provide an immediate reaction to those levels, we zoom into smaller time cycles, such as this weekly low right here. Wait for the weekly low to get taken out, wait for SMT to take place, boom. That's your confirmation that we're likely going to expand higher soon. So with that being said, this first lecture of the Predicting Price series comes to an end. I hope that you found it insightful. I hope that you were able to learn a lot from it. During the next lecture, we are going to be looking at weekly profiles, but I hope that this lecture has provided you with insight on how we can anticipate the month to deliver. I look forward to speaking to you in the next lecture. Be safe.